All right, hello everyone. My name is Amelia, and in this video, I'm going to walk you through the Bonaparte Investment Philosophy Lab. And before we begin, I wanted to point out that this walkthrough is designed for people who are familiar with common investing terms, but need a clearer framework for understanding how these concepts work together. All right, first, this tab basically helps define what an investment philosophy is and what it's for. The questions here in the yellow box, they'll help determine the rules so that it all comes together to create the backbone for evaluating investment opportunities that we come across. In many ways, this reflects our personal philosophy because of how it reveals our approach to risk, uncertainty, patience, and change. Having an investment philosophy basically will help ground you as an investor and is the mechanism for when your emotions tempt you to abandon ship and sell everything. All right. Now that we have the definition out of the way, let's go to the next tab where it addresses time horizons. Okay. So this is a very important concept because it determines what kinds of investments and risks make sense for you. And so here are the five different classes of time horizons that you can read through. They basically describe what kind of investor makes decisions, what information matters to them, how much attention the strategy requires, and how they might respond to a market decline. And so let's go ahead and choose the investor class. You could read more about how time impacts risk and how it helps compound, basically. This is an important uh, concept right here. All right, moving right along. Here, we do have four investors that approach the market very differently. Here you have Warren Buffett, who notoriously focuses on durable businesses, reasonable prices, and holding for as long as humanly possible. Peter Lynch looks for growth at a reasonable price and believes investors have the advantage of noticing strong companies through their experiences as consumers. Ray Dalio's philosophy here is less about those individual companies and is more interested in balancing risk across different economic cycles. And then over here, last but not least, is Joseph Bonaparte. He puts a lot of emphasis on innovation, behavioral biases, and quality growth companies in areas such as AI and fintech. Down here is the matrix where you can compare each philosophy based on factors such as diversification and what their key screening method is when assessing companies. All right. So this tab here, you can build your investment philosophy. So my philosophy is directly correlated with my personal interest and goals. So we'll use that as a demonstration for this exercise. So I'm going to go ahead and click none, and then let's choose all of these guys over here. I'm going to go ahead and leave this blank. I like the full list. And I'll do the betas too. PE Max, let's do 80, and then ESG, let's do 50. 50, yeah. Okay. And then let's keep this market cap bracket. All right, this shows 50 stocks. And then what I'm going to do is I'm going to actually scroll down and I'm going to choose all of the companies that have a 5-year return that's higher than 200. So I'm just going to scroll down here, NVIDIA, and then Meta. I'm almost here. Not Ellie Lilly. Okay. Project. Netflix. ServiceNow. I Auto. Yeah, that looks like it's it. Awesome. So 12 were selected. Let's hit optimize. It goes right to the next tab. And then perfect. So in this stage, we'll examine how the companies interact within a diversified portfolio. So the modern portfolio theory looks at expected return, volatility, and how the stocks move in relation to one another. So the goal here is to find portfolios that offer the highest estimated return for a given level of risk. So I'll go ahead and simulate the highest amount, which is 5,000, max position size. Let's do 20, and then leave the risk-free rate right there, and then run the optimization. And then would you look at that? Okay, so here's the different companies that are going to be in the portfolio. And then here's the return, the volatility, variance, and that Sharpe ratio. All right, so as you can see here on the graph, each of these dots represent a differently weighted portfolio. There's supposed to be a curve, which represents the efficient frontier. Fortunately, it's not here. And the highest Sharpe ratio is a star. And so actually, if you go to here, this is your Y, this is your X. And so if you hover over that exact position, right there. Perfect. So that's where the max Sharpe, basically the best risk adjusted return would be. And we're just going to assume that it's attainable, just because the efficient frontier curve isn't there. But yeah, I mean, that's pretty good. Let's go ahead to here and back test. I'm going to emulate myself and go for the lowest amount, which is 10K. Leave this as annual, and then the benchmark, keep it at S&P 500. And it looks like this. Here is the summary, the performance summary. I beat the market with this portfolio. And here's a breakdown by year. Here is the breakdown of the different sectors that contributed. And then you can spend time reading reading this statement that it basically put together for you. See if you resonate with it. All right. To the next tab, which is execution. Dollar cost averaging is a pretty big deal. It's you could see different reading material that you could go through. Here's the different alternatives to that. There's even a simulator down here where you can just kind of play with the toggles and the different options. Yeah, perfect. Okay. And so I would say that monitoring is the best test, um, just because you're able to, you know, see how the logic and reasoning behind your investment philosophy performed in the market. So these over here are the different reports that you can analyze that'll help you gain some clarity on the stocks that you've chosen. Since there's so many factors to consider when valuing a company and measuring success according to the EPS, I mean, it could be one of the strategies you choose. However, it is good to research and be aware of all the peripheral activities that are determining that value. Here's another simulator where you could assess your decision-making skills and how it kind of compares to how Professor Bonaparte would choose. So like, for example, let's choose Amazon, and then maybe after looking at the report, you say, yeah, I'll buy more. Okay. So you can kind of see the different options here. I mean, this is especially useful, especially while you're still constructing your own philosophy and need some guidance while you're on the decision making. So yeah, I mean, the main takeaway from this lab really is that investing should be a process, not a series of these disconnected decisions. A clear philosophy will help determine what to buy, how much risk to take, how to build the portfolio, how to invest consistently, and when new information should change your original thesis. I mean, ultimately, the purpose of an investment philosophy is to remain steady when markets, headlines, and emotions make consistency difficult. Yeah, so I mean, have fun with this, and I hope you enjoy this video.